Welcome to The Explainer. You know, if you've been glancing at your portfolio lately, you might be feeling, well, honestly, a little panicked. The headlines are screaming, the market looks absolutely chaotic, and it is so incredibly easy to feel like the sky is just completely falling. But today, we're going to cut through all of that noise. We're going to look at what the market is actually doing, and much more importantly, what it means for you. And to help us visualize this chaos and build a really common-sense survival guide, we've brought along our trusty doodle stickman. He's going to help us turn some of these scary, abstract financial concepts into simple, everyday ideas so you can navigate this whole storm with confidence. All right, let's get right into it.
Okay, let's dive into this. 4 out of 100. Now that's not a typo, guys. This is the CNN Fear and Greed Index, which is basically a gauge that measures the exact emotion driving the market right now using real-time stuff like market momentum and price volatility. On this scale, 0 is maximum terror, and right now, we're sitting at a 4. That puts the general market sentiment firmly, and I mean firmly, into the extreme fear range. So if you've been glued to your phone just endlessly doom scrolling, this completely validates what you're feeling right now. Investors are absolutely terrified out there.
And here is exactly why everyone is so spooked. At the time this data was pulled, the market was down nearly 18% from its all-time high back in February. That is a steep, very noticeable drop. And honestly, it means we're teetering dangerously close to a dreaded financial milestone. We're sort of standing right on the edge, looking down and wondering if we're going to cross this specific, highly talked about threshold that literally sends shivers down investors' spines.
In that threshold, it's the bear market. We officially enter a bear market when the overall market closes a trading day down 20% from its previous high. So, sitting at almost 18% down, we aren't technically in one just yet. But honestly, whether we officially cross that 20% line or not, people are already panicking. The emotional damage is already done. But before we let fear completely take the wheel, we need to formally define this beast we're dealing with so we can actually understand it instead of just running away from it.
And this brilliantly illustrates a super simple way to remember where these names actually come from. Just picture our doodle stickman coming face to face with a bear. When a bear attacks, it stands up and swipes its heavy claws straight downward. That downward spike is exactly the shape a declining market takes on a chart. On the flip side, think of a bull attacking. It thrusts its horns upward, lifting everything up into the air. That upward slope is your growing positive bull market. Right now, with prices dropping, we are definitely feeling the downward swipe of the bear's claw.
But here is the absolutely crucial thing you need to hear today. Seriously, I want you to really let this sink in. Bear markets are normal. I'll say it again, they are completely 100% normal. Recent data from Vanguard shows that since 1972, we've experienced, on average, one bear market every 4 years. So while the dramatic news headlines desperately want you to believe these are, unprecedented, apocalyptic times, the math tells a totally different, way calmer story. These drops are just a regular, fully expected part of the investing cycle.
Now, what's really interesting about this historical comparison is when you look at the big picture. First Trust looked at data from 1942 all the way to 2024. A bear market brings an average cumulative loss of about 32%, and it lasts roughly 11 months. Now that sounds painful, right? But contrast that with a bull market, where the average cumulative gain is a massive 150%, and they last on average 4.3 years. The math essentially proves that the depth of the canyon is tiny compared to the height of the mountain. The ups vastly outweigh the downs in both frequency and magnitude over time.
Which perfectly sets up one of my absolute favorite analogies. Walking up a mountain with a yo-yo. Picture our little doodle stick man hiking up a steep, massive mountain. That mountain, that represents your long-term wealth growth. But as he's hiking, he's playing with a yo-yo. And that yo-yo is constantly going up and down, up and down. That is the short-term market volatility we are experiencing right now. If you just stare at the yo-yo, you're going to feel dizzy and panicked. But if you zoom out and actually look at the hiker, you see he is steadily climbing higher and higher up the mountain. Let's move to how this builds into a really dangerous psychological pitfall. When you only watch the yo-yo, you fall into what we call the doom scroll trap.
You see those tickers flashing red, the fear index spiking, and your primal urge just kicks in. Sell everything, go to cash. It feels safe, right? It feels like you're stopping the bleeding. Trust me, financial professionals get these panicked phone calls all the time. But historically speaking, cashing out purely out of fear is the absolute worst move you can make for your wealth.
Hey, don't just take my word for it. Let's break down the hard Vanguard data. They looked at the probability of underperforming a standard 60-40 investment portfolio if you try to go hide in cash during market volatility. And man, the numbers tell a brutal story. If you sit in cash for just 3 months, you have a 74% probability of underperforming the market. 6 months, a 71% chance. And if you stay in cash for a full 12 months trying to wait out the storm, you have an 87% probability of losing out to those who just simply stayed invested. Trying to time your exit and re-entry almost guarantees you're going to fall behind.
So why does trying to time the market fail so spectacularly? It all comes down to one core truth. The best and worst trading days usually happen right next to each other. Generally, about half of the best days happen in down markets, and half of the worst days happen in up markets. Massive, explosive recoveries happen rapidly alongside the terrifying crashes. If you're hesitating on the sidelines, waiting for some magic all-clear signal, the market is going to launch without you, heavily punishing you for stepping away from your strategy. To really hammer this home, just consider this staggering number: 50%. Let me give you a shocking historical fact from the Great Recession. If you panicked, went to cash, and missed just the 10 best trading days in the recovery following that massive crash, you would have missed out on 50% of the total gains. Think about that. Half of your wealth-building potential completely wiped out simply because your money wasn't in the market on 10 specific days. You literally have to be present to win. Now, look, of course it's easy for me to sit here and say, just stay invested, but we have to acknowledge the reality on the ground here. When it rains, it pours. Bear markets do not exist in a vacuum. They are very often accompanied by real-life economic stressors that directly strain your household budget. We're talking about rising prices at the grocery store combined with increased job volatility and income instability. It creates a ton of real, stressful uncertainty in your day-to-day life.
So the crucial point is how we actually prepare for these intertwined stressors, keeping our doodle stickman completely secure so he's never forced into that doom scroll trap we talked about. And the strategy really depends on your stage in life. For older investors approaching or already in retirement, you need a substantial buffer, generally more than 18 months of living expenses sitting in cash. This stops you from being forced to sell your investments at depressed prices just to pay your bills. Meanwhile, younger working-age investors need a robust emergency fund of 3 to 6 months of living expenses. This is your armor against a sudden job loss or income disruption. It gives you the flexibility to weather the storm without ever touching those investments.
And once you have that cash buffer in place, you are free to maintain a long-term perspective. And I really want to leave you with a deeply comforting dose of historical reality here. According to the S&P 500 6-year hold rule, if you simply remained invested in the market for at least 6 years during any period since 2004, you survived the catastrophic 2008 crash, you survived the scary 2018 dip, you survived the unprecedented COVID drop. In every single scenario, you always came out ahead. Holding your investments for the long term actually turns these terrifying market declines into incredible wealth-building opportunities rather than threats. Which brings us to our final question today, and honestly the most important decision you have to make right now. Will you let short-term panic cut the yo-yo string, or will you keep climbing your mountain? Understanding that bear markets are temporary completely allows you to stay the course. Equip yourself with that emergency fund. Ignore the scary red tickers and let the historical momentum of the market work in your favor. Don't let fear derail your financial future. Keep climbing that mountain, and I promise you, your future self is going to thank you. That's all for this explainer. Keep learning, stay focused, and I'll catch you on the next one.
Freedom isn't given, it's built, and it starts with what you do next.